Are you ready in case Donald Trump's actually going to cause a horrific bear market and recession, all that kind of stuff? What if it's actually coming? What if the damage has already been done? Trump and his tariff nonsense has just caused too much pain and fear in the markets, and there's not really going to be any reversing it now. This train has been set in motion, and it's on runaway rails, man. It's not going to stop. Even if it reverses course now, it's just going to be too little too late. Well, it's an interesting theory, and it is plausible, although I think there's a very clear window we can jump through for the bulls with tariff fears easing, trade deals being made, global M2 pumping, all that kind of stuff. But we always have to consider the bear case. And I want to show you 4 different charts that say, well, trouble could just be around the corner. So buckle up, because the numbers from Pennsylvania, New Jersey, and Delaware could be screaming danger. They may be the canary in the coal mine of the economy and show that a recession could be a lot closer than people think. And we need to learn why these particular indicators act as a bellwether for the whole U.S. economy. So stick around, because the last thing you want to be doing here is being caught with your pants down. It's never fun. So there's a reason that Trump's pushing to bring manufacturing back to the USA. It's all about jobs. More jobs means more stable incomes for consumers. Those consumers then buy more products and services, boosting, of course, then company profits and margins. US is largely a service economy nowadays, but there are some things that America does manufacture and probably should be manufacturing, like rare earth minerals and microchips and stuff like that. Now, bigger profits, of course, lead to expansion, creating even more jobs because more people want to buy stuff and creates more demand. And according to a 2025 article from the National Institute of Standards and Technology, or the NIST, manufacturing added $2.91 trillion to the U.S. economy in Q2 of 2024, accounting for around 10% of U.S. GDP. Again, really shows what a service economy America is. It also has a multiplier effect. Every dollar spent in manufacturing generates an additional 2.69 for the economy. The sector employs 13 million workers with an average salary exceeding $102,000, and the U.S. manufacturing sector represents 16% of global output. Kind of a big deal. Simply put, what happens in manufacturing, particularly in the USA, ripples across the entire global economy. Now, speaking of ripple effects, some negative numbers are starting to come out from the 3rd Federal Reserve District. The Philly Fed Manufacturing Index just plummeted to minus 26.4 in April of 2025, down from a comfy 12.5 the month before. Now, in case you're wondering, this index is compiled from a survey of about 250 different manufacturers in the 3rd Federal Reserve District. So that's composed of Eastern Pennsylvania, Southern New Jersey, and Delaware. So it gives us an insight into kind of the direction of change in overall business activity and various factors like employment, orders, shipments, prices, stuff like that. Obviously, we have to mention a lot of this stuff has been distorted because of tariff stockpiling and tariff fears and all the kind of stuff related to that. But a reading above 0 generally suggests expansion in manufacturing sector, while a reading below 0 indicates contraction. And we are well below 0 in this current situation. Let's check out another chart here. The Philly Fed New Orders Index. It's bloodbath, crashing to minus 34.2 in April from 8.7 the month before. That's a big fat nope for factories cranking out stuff like pharmaceuticals and chemicals in the 3rd Federal Reserve District. Now, for what it's worth, we've also had indication that at China, similar situation. Factories ground to an absolute halt. Orders have stopped coming in. Everyone's terrified to spend any money right now in the current economic situation with all the tariff fears. This index shows how many manufacturers are seeing new orders basically drop massively versus rise, and minus 34.2 means you are basically losing a lot of orders in that situation, and companies are suffering. You can probably guess what that means. No orders, no production, start having to fire people, go bankrupt, all that kind of stuff. It's the death knell for production lines. But wait, it gets worse. It gets worse. Manufacturing is getting hit with a double whammy. You'd think fewer orders would mean cheaper raw materials to make products, but nope. Suppliers like, nah, brah, prices are gonna go up. The Philly Fed Prices Paid Index, which tracks what manufacturers are actually paying for stuff, shows that costs have actually been climbing since November 2024. It's now at 51 in April, up 5.59% from last month's 48.3. Since anything over 50, of course, means that factories are basically paying higher prices. Not fantastic news. Again, data slightly distorted by the massive buying pre-tariff. Obviously, it's also up 119.8% from a year ago. That's a massive cost spike. Now, from a year ago up to January 20th, that's not Trump's economy. But what we get now is Trump's economy. So do the math here. Higher costs plus shrinking orders equals squeezed margins, which could spark a chain reaction. Think layoffs, think less production, less tax revenue, all that kind of stuff, right? Businesses don't expand more. Everybody's in a bad situation. This has a ripple effect that could tank markets, creating a massive bear market for stocks and a big recession for the wider economy. Scary shit. Now, before we jump to the next chart, guys, if you ever wanted to trade crypto without all the bullshit, without all the hassle, without uploading your IDs, waiting a few days for approvals, being told your country isn't eligible to trade anyway, well, that's exactly why you should go and check out what the guys over at Femex are doing. This is available to everyone, everywhere. You don't need to have KYC to do this. All you have to do, use the link down below. You can start trading. No KYC necessary. Everybody everywhere can use it. You can trade all the big coins, Bitcoin, Ethereum, Solana, top dog coins, all that kind of stuff. Look, I've been using Femex for a long time, and I've done a lot of trading over there, and it's always been super smooth, super fast, and reliable. Plus, they are having some insane deals right now, some super solid offers here for you, some great bonuses. Now look, just use that link down below. You're gonna get $10 for free just for starting your account. You're gonna get up to $500 in deposit bonuses and up to $1,200 in trading bonuses. It's crazy stuff. If you're looking for a no-nonsense, no BS exchange that just works, link down below in the description. Go check out Femex. Okay, now back to this conversation. Let me ask you a question. What's the biggest expense for the average person in their lifetime? Well, according to a one-man financial study, the typical American spends $3.3 million over the lifetime, and a whopping 44%, that's over $1.48 million, goes towards buying a home. Now, for most people, owning a house, it's the dream, man. It's the American dream. Get your house, white picket fence, the one car, the 2.4 kids, boom, you're good to go. Don't ask how they divide up the third kid. It's a basic human need right up there with food and water. You gotta get your house, man. That's why the housing market is such a solid way to check the pulse of the economy. And guess what? Right now, it's effing dead. Let's look at the US housing starts month over month. So this tracks the percentage in new housing units starting construction each month compared to the last. And before we share this data, I'd just like to say the US has basically been in a recession since 2022. When we first had our first 2 quarters of negative growth, the stock market popped back viciously only due to government spending. Jobs remained high because the government hired millions of people. Anyway, this particular index is flashing a big red warning sign. It just tanked 11.4% in March 2025, hitting a seasonally adjusted annualized rate of 1.324 million units. That's the steepest drop in a year, especially after a 9.8% jump in February. Seeing a basic need like housing take a nosedive, that's a bit worrying for the economy, isn't it? Now, I know what some of you are thinking. Oh, yeah, okay, Lark, the housing index is worrisome, but the other indices, they're just numbers from the 3rd Federal Reserve District. It's not right. Who cares if Philadelphia and New Jersey are having a hard time? Not a big deal, right? It's only 3 states. Well, you got a point there. This is true. It's true. America's a big, diverse economy, a lot of stuff going on. But we do have to consider that these states are not small fries, okay? The Philly Fed Index has a strong track record of forecasting key U.S. economic indicators before official data actually reflects it, since basically it is a microcosm of the U.S. economy. The numbers really do speak for themselves. The 3 states have a combined GDP in excess of $1.5 trillion. That's according to 2023 numbers, which is about 6% of the national GDP. It's also almost as big as countries like Spain, or bigger than countries like Indonesia, which is pretty crazy to think about. Now, the 3 states, they host several different manufacturing giants like Merck and Hershey's, which are relatively diverse and big employers, by the way. So any bad numbers coming from these 3 would surely hurt the national economy and would be representative of the wider economic situation if layoffs start happening at Hershey, for example. Now, we've seen the bad numbers. So should we just raise our hands and surrender? It's over, man. Look at those bad numbers Lark shared in this video. It's over. Sell everything and run for the hills. Buy gold. Well, those numbers look bad, and we're sharing the bear case here because it's important to understand this information. Like I said, there's still a beautiful window we can jump through for the bulls, right? And we're just always one tweet away from a mega market pump, new all-time highs, or a mega market dump, depending on what Donald Trump's mood is. In fact, let me share an interesting perspective for you. This tweet here from Bitcoin Data 21 shows that the macro cycle is nearing a bottom or has bottomed. This aligns with the business cycle, by the way, which is also at a bottom. So once the tariff fears subside, we are macro-wise speaking anyway, near bottomed on many major indicators with stuff like global M2 pumping, setting up a near perfect scenario for markets to do well in the coming 6 to 18 months, with the dollar showing a lot of weakness, which is what Trump wants. Trump wants a weaker dollar to give better trade negotiations and to free up US exports. Assuming the trade wars don't heat up massively from here or don't become a real war, China invades Taiwan or some BS like that, then we should be okay. Okay, in my opinion. I know these are some worrying numbers, but these things can turn around just as fast as they tanked, okay? And it's never too late to turn the ship around. But next time you see markets pumping, for crying out loud, take some damn money off the table, okay? That's how you win. Don't take the screenshot. Nobody gives a shit about it on social media. You know who cares? You, your family. Okay, take care of your family, take care of yourself, take some money off the table next time. Whether this is a relief rally it's forming up right now or a rally it takes us to new highs, okay? Because bear markets, downtrends, epic crashes, they're always just around the corner. There's always things to worry about. Every bull market climbs the wall of worry. Every bear market walks down the steps of worry or jumps off the cliff of worry. Use the time-proven strategies for building wealth, okay? Keep consistently investing, keep paying attention, take your money out of high risk, put it in low risk, all that kind of stuff, because nobody can accurately predict exactly what's going to happen in the markets. I don't have a crystal ball, you don't either. But planning for both bullish and bearish scenarios is what gives you a better chance of winning, which is why I share these kind of videos with you guys. You need to know the bear case as well as the bull case. And I'm ever the optimist, relentless bull on the markets, but sometimes we're in downtrends. We've been in a downtrend recently. Could we be breaking out now? Well, time's going to tell whether or not this is a real definitive breakout. But by the time we have 20 confirmations of that happening, some of the best price gains are already gone. Investing is always risky. It's not safe and comfortable. When it feels safe and comfortable to jump in and invest, that's the most dangerous time. But remember, when it feels almost scary to take profits, I'm going to be an idiot. I'm going to wake up tomorrow, everything's going to be about 10x more. That's probably a great time to sell. Book profits on the way up so you can have money for the next time a big dip comes. Okay, and if we keep dipping from here on out, well, it's going to bottom at some point, guys. Thanks for watching.